Hello Vision Nation. In this episode, we're going to cover how Ed Thorp went from beating casinos at blackjack and roulette to starting 2 hedge funds that had record-breaking returns for investors. Ed's such an interesting person. He holds a master's degree in physics and a PhD in math, and he founded the first quant hedge fund ever. In 2021, his net worth was over $800 million. Not bad for a former university professor. By the way, special shout out to Aaron Fifield from Chat with Traders podcast. Aaron interviewed Ed, and the audio clips in my episode are from that interview. I'm gonna link to Aaron's interview in the show notes. He has a great conversation where Ed goes in depth on a lot of these investing topics. So if you enjoy my episode, definitely check out Aaron's interview as well. One last thing, if you guys want to get in touch to say hello, you can reach me at visionwallstreet@gmail.com. I'm going to put that email in the show notes as well. Welcome to Wall Street Vision. This show is on true stories about markets and top investors. I'm Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. So Ed was fascinated with science when he was younger, but he also had this entrepreneurial go-getter attitude as well. He tried a few different ventures when he was a kid growing up in Chicago, from selling cups of Kool-Aid in the street to shoveling driveways and delivering newspapers at 2 o'clock in the morning.
I remember when I was 5 or 6, I was selling Kool-Aid to WPA workers in the street. I would buy a 5-cent pack of Kool-Aid and make 6 glasses out of it and sell them all for a penny a glass. And they were very happy to see me because they were working out in the heat for very little pay. So I realized I could turn 5 cents into 6 cents over and over with a fair amount of work.
His parents were poor, and Ed was growing up after the Great Depression, so he knew that if he wanted to buy anything for himself, stuff like science equipment to do little experiments at his house, and things like that, he'd have to make money on his own to buy those things. It's inspiring having that sort of mindset at such a young age. He also started reading when he was very young, and that opened up a whole new world for him. Now, their family didn't have a lot of money, so both his parents worked long hours. This meant that Ed and his brother would be left alone a lot of the time.
Well, when I was a kid growing up in high school, I was left on my own a lot. My parents were working in defense, or in that case, war industries, and my mother had the swing shift, 4 p.m. to midnight. My father had the graveyard shift, midnight to 8 a.m. at another industry. And so I and my brother kind of took care of ourselves and grew up without any particular supervision. And that was good and bad. It was bad because I didn't have the opportunities that kids with more money and who went to a better high school would have. But it also taught me to think on my own about things. And so when I came across situations later in life, I often looked at them from a fresh viewpoint.
He went on to university and he ended up getting a PhD in math and a master's in physics. So he was very bright and super focused. During this academic career, he read this research paper that discussed how blackjack players playing at casinos could get the odds of the game close to even using specific strategies. Even odds simply means that the player could play against the casino without losing or winning any money. The player would win some hands, and then the casino would win some hands. The net effect would be that no money would be lost or won on either side. By the way, for anyone not familiar with blackjack, it's one of the simplest casino games where the goal is to get 21 points using a combination of cards. It's a very fast-paced game where each game might take a minute or two to play. The research study that Ed found is what's known today as basic strategy. So with perfect basic strategy, a blackjack player has almost even odds playing against the casino. They're still at a small disadvantage, and of course if the player makes any mistakes, they're going to lose over time. Ed built off that research and figured out a strategy that he could use to get an actual advantage over the casinos. His only problem was that in order to prove his strategy worked, he'd have to do tons of calculations by writing out math equations on paper by hand. Because this is the 1950s, not everyone has access to computers.
Well, I spent a substantial amount of time during the spring and summer of 1959 trying to do it by hand. And I realized as I made relatively little progress that the computation was so enormous that I was never going to finish in my lifetime. At that point, I learned that MIT had an IBM 704 computer, and as a staff member, I could use it. So I taught myself a programming, something called Fortran 2, and then I got all the information I needed, and I saw I could beat the game. And I saw how to do it in multiple ways.
How amazing is this guy? He has this problem that he's got to solve, and he finds out that the math is nearly impossible to figure out by hand. So he teaches himself programming to overcome that. What a great example showing that if there's a will, there's a way. He wrote up all his research into a paper, and he submitted this paper to a math committee showing this method of beating the casinos. And the whole committee thought that he was nuts. At the time, casino games were thought to be unbeatable. And this is not a thought that just the everyday person had. This was a thought that the top math PhDs had in the US. It takes courage to go against conventional wisdom, especially when you're going against the brightest minds in the country. You've got to remember, this was before card counting was well known as a way of beating casinos at blackjack. There were a few people in Vegas who did a crude form of card counting, but no one really knew about it outside of a very small circle of people. So this card counting method that Ed wrote about was truly revolutionary. And by the way, card counting works by keeping track of which cards have already been played and are now out of the deck. When a player keeps track of this, they have an idea of which cards are still in the deck. So it allows players to know the odds of getting an ace or a high card. Those are the cards that have the most points in the game. So here came this Ed Thorp guy showing his research, and he's saying that casinos could be beat with card counting. His research paper caused a huge stir, and it got quite a bit of press.
Well, many people came to my talk, and afterwards there was a lot of publicity in both print and on television. And then I began to get people offering to bankroll me. And one very persistent guy kept calling. And finally I said, the casinos are scoffing at me. They're saying this is all garbage. They're saying they'll send a cab for me. And if I don't do anything, people are going to say, well, this guy is just a blowhard who claimed to do something but couldn't back it up. And I felt it was obligatory for me to show that what I'd done was actually correct and worked.
One guy that got in touch with Ed about working together was this guy named Manny Kimmel.
So I finally decided to listen to Manny Kimmel, who drove up from New York. So we talked for a while, and he got very excited. It turned out, although I didn't know all this at the time, that not only was he a wealthy businessman who owned 64 parking lots in New York City, among other things, but many years later, I discovered that Manny Kimmel had been associated with mobster number 2, a guy named Longy Zwillman. He was the mobster king of New Jersey in the 30s. So he probably made his original money from bootlegging, prostitution, and so on.
Yikes! Sounds like Manny was quite the character. The basic deal was that Manny would provide the money, Ed would play blackjack, and they'd split any profits. Manny wanted to start with a $100,000 bankroll for their Vegas trip. That's close to $1 million in today's dollars, but Ed felt uncomfortable with that massive amount. So he started playing with a $10,000 bankroll instead. When they first started playing, Ed was only making bets that were in the $1 to $10 range. This was driving Manny crazy because they came out to make money, and here's Ed playing with these tiny single-dollar bets. But the lesson here is that Ed had a gut feeling about managing his bankroll. He wanted to only play with amounts that he was comfortable with. Also, I'm sure you don't want to lose $1 million that belongs to a mob guy. That doesn't sound like a great idea. So after several hours of playing, Ed kept on increasing his bet sizes, and toward the end of that trip, he was putting down the biggest bets that the casino would allow. Long story short, that was a super successful trip, and they essentially ended up doubling their money. Ed went on to write a book about how to count cards in blackjack, and the book was called Beat the Dealer. It was a massive success considering how niche the book was. It became a bestseller and sold hundreds and hundreds of thousands of copies. But he wasn't happy to leave it at that. He wanted to see if there were other ways to beat casinos. Ed was a big science guy, and he had a good understanding of physics, to the point where he saw roulette and started to think that might be a beatable game. I was blown away to learn about this part because to me, the roulette game seems like it's a game that's all about luck with zero skill involved. It just seems so random on which number the ball is going to land.
Well, roulette actually is the first thing I thought about in my life that was a beatable casino game. It was way back when I was in high school and studying physics. And what I realized was that the roulette ball orbited kind of like a planet, and the spinning rotor didn't really make any difference. It just changed the relative rate in which the ball orbited around whatever pocket it was going to end up in. So I thought of it mainly as a lot like a system that is so predictable, the motion of the planets around the sun.
Wow, that's very cool. Ed's basic premise was that if you could calculate where the ball was relative to the roulette wheel, and if you calculate the speed with which the roulette wheel and the ball are both moving, you could have a range of probabilities for each of the numbers where the ball is going to end up. So you might have a cluster of 4 numbers that you'd bet on because the ball had good odds of landing on one of them. If any one of those numbers wins, you get a huge payout of $35 for every dollar wagered. So even if one of those numbers hits, Ed would make a lot of money. To put this idea into motion, Ed got together with a brilliant guy named Claude Shannon, and they worked together on this. They made a small wearable computer that had little electrical buttons that you could put in your shoe, and Claude would press the buttons based on how fast the ball and the roulette wheel were spinning. The computer would then tell them which numbers to bet on. By the way, the roulette wheel is also called the roulette rotor, so that's the same thing, wheel or rotor.
And when I heard the instructions from the computer, then I put money down on a few neighboring pockets. For example, 0, 13, 23, 36 is a little group that hangs together on the wheel. We bet on 4 or 5 numbers that were neighboring, and a pile of dimes would blow up into a whole lot of dimes very quickly because we had, it turned out, a 44% edge, which is really huge. I mean, you almost never come across anything like that.
Okay, so now you're probably thinking, wow, these guys were the first people to figure this out. So they probably just kept on hitting up different casinos night after night and stacking $100 bills, laughing all the way to the bank. Well, not really. Ed thought about it and he realized that the only way he was going to be successful is if they kept on using disguises and being sneaky with the casinos. Because otherwise they'd get noticed very quickly. He didn't want that sort of lifestyle, so he just went ahead with his academic career instead. And by the way, other people found out about this system that they used, and those other people ended up making a fortune in roulette. Ed has a few examples in his career where he could have made a lot of money, but he walked away from the opportunity because he chose to do what was interesting to him instead of just chasing dollars. So throughout all these casino stories, you've got to remember that casinos at the time were known for using violence in certain situations. For example, if a casino caught you cheating, they would probably drag you to the back room and then beat the hell out of you. When Ed played, none of the stuff that he did was really cheating, but Vegas was still a really rough place. If you've ever seen the movie Casino with Joe Pesci and Robert De Niro, it shows a lot of the type of violence that was happening. Well, the movie is set in the 70s, and Ed was playing in the 60s when the violence was even worse. One weekend, Ed was at a casino with his wife and another couple. They were playing Baccarat side bets, which is another game that Ed figured out how to beat.
And I figured out a way to beat them systematically. And so we came and did that night after night after night until finally they drugged my drinks and barred us from playing anymore. And on the way home, a strange thing happened to the car I was driving. The accelerator locked to the floor when I was coming downhill in Arizona, and nothing I could do with the brake seemed to be able to stop it. So I finally got up to 80 miles an hour. I put on the handbrake, the foot brake, put it in a low gear, turned the engine off, and used the drag of the motor also. I was finally able to bring it to a stop. And then somebody came by and looked at the car and said, I've never seen anything like what's going on here with the connection to the accelerator pedal. Their opinion was that it had been tampered with.
That's a freaky thing to happen after you were just kicked out of 2 casinos. There was also this meeting that happened around that time. The meeting had some of the head casino people, and they discussed breaking knees and getting rid of Ed.
This was the Nevada Casino, the Nevada Resort Hotel Association meeting. There was a big discussion about how to deal with me and the count counters. And so one of the proposals was to break knees or worse.
As you can see, beating the casinos raised some problems. If you're really good and you win lots of money from them, you're going to get noticed, and casinos don't like that. So Ed started to think of doing something else. And the stock market was the perfect alternative. He described Wall Street as being the biggest game in the world. Unlike a casino, if you make lots of money from the stock market, no one's going to come into your office to bust your kneecaps. Instead, you're just going to get lots of clients wanting to invest with you. So in 1969, he started his first hedge fund. It was eventually called Princeton Newport Partners, or PNP. Before we dive into what happened with Ed's hedge fund, I'll quickly mention that if you're enjoying the podcast, please hit the subscribe button. And if you know someone who would find this content valuable, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. This show doesn't have a marketing budget, so the only way we can grow is with your help. Thank you, Vision Nation. All right, back to the show. Just like with blackjack and roulette, Ed was a pioneer in the investment business as well. He started the world's first market-neutral hedge fund. The idea behind market-neutral funds is that they make money no matter what happens in the stock market because of the unique investment strategies they use. So their goal is to make money if markets go up or down. His main area of focus at the hedge fund was called convertible bond arbitrage. Now that sounds like a whole bunch of mumbo-jumbo. And this can get pretty technical, and I don't want to bore you with all the details. Here's a 30-second breakdown of a basic strategy that they'd use. This is not really important to the story, but if you're familiar with some finance terms, you might find this interesting. So one example of what they'd do is they'd buy a convertible bond that has an option of being converted into shares of the company. And at the same time, they'd short sell the stock of the company. That's an interesting investment combination. Here's how it plays out in theory. If the stock price decreases, they'd get a return from the short sale of the stock. The bond might decrease in price as well, but it probably won't decrease as much as the stock. So they'd make a positive return in that scenario. Now, if the stock price increases, the short stock position is going to lose money. But the bond is going to allow them the option to convert the bond to shares, which means that the total losses are limited. And depending on how many bonds they own, they could still make money in this scenario as well. And if the share price stays the same, they just collect the coupon on the bond, which is like the interest payment that the bond pays out. Okay, so the actual strategies that Ed used got a lot more complicated than that. But that's the basic premise of what they did at his hedge fund. The strategy worked really, really well. The fund ran until 1989, and they compounded over 15% annually after fees. The before fees return was around 19%. By comparison, Warren Buffett's long-term rate of return is around 20%. And that already makes Ed's returns look amazing. But what's even more impressive is that out of 227 months that the hedge fund was in business, they only had 3 losing months, and all of those losses were under 1%. That's just incredible. When most people invest in the stock market, they expect some lumps and ups and downs along the way. But Ed's fund was able to make that amazing return with only 3 losing months. Eventually, that hedge fund got shut down because Ed's business partner ran into some trouble with the government, and it caused a lot of bad press. His second hedge fund was called Ridgeline Partners. It ran from 1994 to 2002, and that fund was super successful as well. They achieved a 21% annual return with very low volatility. Ed's net worth is estimated to be around $800 million as of 2021. And the crazy thing is that he wasn't purely focused on making money throughout his whole life. If having as much money as possible was his sole goal, I'm sure he would have had a bigger net worth. But there were quite a few times in his career where he walked away from making more money because he wanted to follow his curiosity instead. So it's very cool that he accumulated such massive wealth. I love how he brought forward such a fresh perspective to each of the things he did, from blackjack to roulette to the markets. Elon Musk talks about using this first principles approach. Essentially, that's where you break down a situation into its fundamentals, instead of relying on conventional wisdom. I think that's what Ed Thorp did in each of the markets that he became so good at. He used this sort of bottom-up thinking to figure out what could be done instead of relying on the opinions of everybody else. At the core of it, Ed's advice for making money comes down to finding a game where you have an edge, and knowing how to manage your money on each individual bet or investment?
Well, there are two parts to making money as far as I can see it. One is finding a good situation where you have an edge, and the other is managing your money. People have different knacks for doing things. There are guys like Warren Buffett who spend their whole life picking stocks and keeping track of companies and knowing balance sheets in their head and looking for bargains when they occasionally come by. There are people who, at the other end, who are high-frequency traders. They have computer algorithms, and they're wired into the exchanges, and they get to look at orders before other people. That's a different game entirely. So there's so many different games. So what you have to do is go find one that works and that suits you.
All right, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, you can check out the episode I did on Blair Hull. That was episode 33 of the podcast, and it aired on October 4th, 2021. Blair Hull was another math guy that used card counting to get huge success in blackjack before transitioning to a career in finance. It's another great story. Thank you for listening, Vision Nation, and I hope you have an amazing day. This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Before making any decisions, consult a professional. I may maintain positions in the securities discussed on this podcast. This show is copyrighted by the Wall Street Vision. Written permission must be granted before syndication or rebroadcasting.